Good evening, everybody. Thank you for joining this webinar, Manage Your Finances While Practicing Overseas. The FIRE Group have kindly agreed to run a second online session to accommodate everyone that was unable to join the live session last time. And for those that are unfamiliar with the FIRE Group, I'll give you a brief introduction before I pass this session on to the expert panel. So the FIRE Group is a distinguished UK-based financial advisory firm. They're established in 1898 by Thomas Bryer, and since then it's evolved over a century into a wealth management provider, covering tax planning, estate planning, financial planning, and investment management. And they have a particular emphasis on serving British expats and international clients. It operates globally and has offices in the UK, Dubai, Singapore, Hong Kong, and Belgium. And above all, I have to say, I've got to know your team, and they're just really laid back, genuine people trying to help those of us that are uncertain with how best to manage our financial uncertainties, the tax man, and achieving financial freedom. So I'm going to pass it on to Stuart, Emil, and Claire, and they'll take on the session from now.
Brilliant. Thank you so much, Napsia. So good evening to everyone joining us on this webinar. As my name is Emil McKenzie, and I have the pleasure of serving as Head of Business Development for Middle East and our offices at the FIRE Group. So it's a privilege to be here with you all today and to host this webinar, which is focusing on an area that is vitally important. So it's all about maximising your time as a British doctor living in the UAE, taking into account financial planning and tax. So as British doctors working in the UAE, you operate in a very unique space. It's difficult, as we can all kind of attest to, balancing your careers with family life and also the complexities of living abroad. And while much of your energy is no doubt devoted to looking after patients, today's session is a chance to focus on something that's equal as important. So looking at your own financial future and aiming for financial freedom and flexibility as you get older. Here at the FIRE Group, we've been supporting British expats for over a century, helping individuals and families making informed decisions about their finances. And our presence in the UAE allows us to work closely with professionals such as yourselves, offering bespoke advice on UK tax, investment planning, estate structuring, and retirement strategies. Throughout today's session, we'll be exploring some of the key principles and practical considerations around managing your finances, from understanding your UK tax obligations to structuring your wealth efficiently whilst being abroad. Our aim is to equip you with all the insights that you need to make smart, forward-thinking decisions. Now, before I start, I'd just like to cover off some housekeeping. Today's session will last for around an hour with our industry experts Stuart McCulloch and Claire Spinks, covering some of the key considerations. We'll then move on to a couple of case study examples before entering into a Q&A for everyone joining today. Please feel free to ask questions at the end, but if, as we go through the presentation, you think of any questions that you want to pop in the Q&A, please feel free to do that as we go along. Following today's webinar, if you do feel like you or wish to receive further information or have any additional questions, please reach out to us at the email address info@thefiregroup.ae and we'll arrange a time to talk in more detail. So on behalf of everyone at the FIRE Group, we're delighted to have you here and look forward to tonight's session. So to get started, on our panel today, we have Stuart McCulloch. Stuart's the market head for the FIRE Group in the Middle East. He's been in the region for many years and is responsible for building our team in Dubai and growing the office to one of the most respected firms in the region, which is no mean feat. And we also have Claire Spinks, who's head of international tax for Progeny, which is the parent group of our company. Claire is one of the brightest tax minds I've ever come across during my career. And the most impressive thing I can say about Claire is that she can somehow make the most complex tax queries sound interesting and engaging, which again is by no mean feat. And then finally, we have Nazia, family medicine consultant, who I'm sure you all know at Genesis. I'd like to thank Nazia personally for helping gather together all the doctors for the webinar and with your busy diaries, and for also the seminar we held a few weeks ago. So we've had the pleasure of getting to know Nazia over the last year. She's a great bud and always such an interesting person to spend time with. So we'll be covering six kind of key areas. The key elements of a robust financial plan, UK inheritance tax planning, pension considerations for British expats. We'll then move on to case studies and a panel discussion before talking about UK property considerations and particularly the tax implications of holding UK property before we move on to a Q&A. So I'd now like to pass over to Stuart, who will talk about the key elements of a robust financial plan. But before you do that, Stuart, would you mind just giving a bit of a background to the Fry Group in the Middle East?
Sure, yeah, thanks, Emil, and thank you to everybody taking the time to attend tonight. Genuinely appreciate it. Yeah, so I set up the Fry Group in 2018. I joined after being approached by them because they were looking at wanting to set up a location in the Middle East as a key area where there's a lot of British expatriates. And I'd been in the region at that point for quite a while, and I'd set up previously Coutts & Co Private Bank as head of operations and Bank of Singapore. So for me, it was a no-brainer to set up with the Dubai International Financial Centre. And then we got ourselves set up, hired the team, got an office, and then started to operate early 2019. Then the team's grown since then. We've added to the team. We've recently moved to a bigger new office as well with plans for expansion across the region. And, you know, we were in it for the long term. I mean, we really do, when we go to locations, do it for the long term. We focus a lot on deal with expatriates rather abroad. And we could all see the flow of traffic into the Middle East and the UAE in particular in recent years. And that's keeping us busy. So it's nice to see the business really starting to thrive. And a lot of clients have introduced us to their friends. And the business is growing, so that things are going in the right direction. So I'm quite happy with that. The key things that I wanted to cover off for you guys first and foremost is looking at key elements of our robust financial plan. The key thing here, the most important thing, that might sound really, really simple, is you need to understand what it is you're planning for. And we find that by working with a professional advisor, we can sit down and look at whether it be pension planning or retirement planning. We can talk about, okay, so let's get into the detail of this. What does retirement need to look like? What do the numbers look like? What do you think you're going to need? What does your lifestyle look like? Where are you going to retire? What would the tax implications be if you retire there? Do you have property there? If not, you know, you plan to buy it. When are you going to do that? And we will sit down and using cash flow forecasting software, plot out the future from today forwards to see what it is that things look like. We then put in the known variables, things like an agreed growth rate or an investment strategy. We'll put in things like effects of inflation. We'll put in things like planned expenditure during that period. And then we'll run the numbers. So it takes away that sense of anyone's opinion. It genuinely comes down to the maths. And then we can start talking about what do we need to do in order to help people achieve their goals. And that's very, very important. So if we look at risk mitigation, everyone should always be looking at having an emergency plan first and foremost. You don't know what you don't know, especially as an expat. And it's always good to have money available for short-term planned expenditure. Protecting yourselves, if you've got, especially your young family. I used to always say to people, you know, if you had a machine in the garden that pumps out your salary every month, you would insure it. So it's no different when it comes to people. And it's important to have protection in place, and that's a key part of financial planning. And ultimately, you need to make sure that you've covered for dependents. Now, when it comes on to saving cost efficiently, now we're looking at things like retirement planning, we're looking at regular shorter-term savings, we're looking at investments as well. What's really important that you look at there is, I always say for an expatriate, you need to have two things. You need to have flexibility because things can change as an expatriate, and you want cost effectiveness. Now, when I say flexibility, I can't emphasize enough. I mean, cost-B flexibility. And the reason why I say that is because there are a lot of people in the region will sell you products that will tell you have flexibility. Like you can change the payments, you can stop the payments or whatever it may be. And they may well have that flexibility, but it comes at a cost. And the impact that cost has on the underlying investment strategy is likely to wipe out any real return that you're going to see. So be careful when someone says it's got flexibility. Make sure you understand what does that flexibility come at a cost of. So, you know, we will always look at putting people into things which have that flexibility at no cost. So if you wanted to change how much you pay. If you want to stop paying in, if you want to take money out, then these things wouldn't cost you anything. And that's important because we have seen scenarios in the past where, for whatever reason, a job doesn't work out, or circumstances change, or someone gets ill back home, and people will need to go back home and stop, what they're doing in Dubai. And I've seen cases that come to us where they've been put into these products which are utterly inflexible. And also, I'll point out, they are also products that will not be acceptable back in the UK. So you might struggle to get an advisor that will take you on. So, be very, very mindful of things like that. But the key thing is, if you go into it and ask the right questions, which hopefully today will help you to do that, you can check what you need to check to make sure that you're not going to come a cropper with some of that stuff. Optimizing tax is always massively important. A lot of people come to the Middle East because they've got the opportunity to earn money tax-free, save money and invest money on a tax-free basis. And that's the starting point of it. It's a great opportunity to do that. And it's important that you do that in the right way. As I say, make it cost-effective. Make sure you're going to products that are giving you that flexibility. Products that are actually designed to actually make you money. Because there are also a lot of products in the vehicle available in the market which are designed to make the advisor a lot of money. They give you it. So be very, very careful on that too. But if you've got the opportunity to work with a professional firm, tax is massively important. And the reason why we say that is because not paying tax gives you an opportunity to really start having a robust investment strategy in place to take advantage of the extra savings that you might be able to do. But also it's about making sure that you plan things for when you plan to return to your home country or UK, for example. And we will always help with repatriation service in relation to things like that, because the timing of when you go back, how you go back, realizing gains before you go back, and all these sort of things are things that you must be mindful of. I always remember a case where a guy came to me. He was talking to potentially becoming a client of ours, but was moving home in 2 or 3 months' time. And he was with the private bank at the time, and he sat on about £900,000 worth of unrealized gains that he'd made during his time in the Middle East. And he hadn't even thought, and the bank hadn't mentioned, that he should sell them all and rebuy it to realize the gains for as a non-UK taxpayer. And he would have gone back, if he hadn't spoke to me that day, with a huge tax bill when he went back to the UK. So little things like that, which sound really simple, but sometimes people forget with everything that's going on. It's important that you do that. Now, the next thing underneath all of that is it says regular reviews. And I can't stress that enough. It's review. Things change, yeah? Your circumstances will change. Tax rules change. Product development happens. Product rules change. What's available in the market can change. So when you do set up a financial planner for a financial firm who do things professionally, they should make themselves accountable to you, to the realization of what it is you're planning for. And that involves invariably regularly reviewing what we've got, just as a matter of course, at least maybe once or twice a year, making sure we run the numbers on the software again to see how we're at based on how performance has actually gone. But also it's about making sure that if there's a trigger event in your life, like you have another child, or you lose your job, or you change your job, or your time frame that you're planning to be in the country changes, always alert your advisor of that, so we can make sure that's planned in to the plan that you've got, so that we can take advantage of the time you've got left, but also make sure that we start to plan for that move back or whatever it may be. So I can't stress that enough. So by sitting down, understanding what it is you're actually planning for, putting together what we would consider the model answer based on where you are today and what it is you're trying to achieve in the time that you've got, understand your attitude to risk, understand your understanding of what you like, what you don't like, and then putting in place the model answer and then reviewing it. And that, in a nutshell, if you like, is what are the key components of a robust financial plan. If there's anything you want to add to that, Emil or Claire, please feel free to speak up.
That is a really good point. I mean, Claire, it'd be interesting to kind of see your view on it, but the one thing I kind of garner from that is absolutely important to come up with a plan in the first instance, but then equally as important is what happens once you've come up with the plan and how that evolves over time. And then the second thing I was going to say, just introducing Claire into it, was the interaction between tax and financial planning, because that becomes so key when you're an expat. And Claire, I mean, you've seen this many a time with many other clients, I would say as well.
Yeah, I mean, I think one of the most important things from our perspective is that people are getting tax advice. And so often when people have left the UK and they've made that, that huge move overseas, there isn't a sort of just an assumption that they're going to be non-UK tax resident. You know, people believe it's very much down to their intention. We hear lots of people saying things like, you know, I've left and I don't want to live there anymore. And actually the residency test, which really underpins whether someone's in the scope of UK tax or not, has nothing to do with intention. So we always see that obviously behaviours tend to follow that, and statutory residency test is largely based on behaviours. But we do also have a lot of conversations, certainly around leaving or going back to the UK, where actually their tax position was not what they expected in that year. So it's a real shame. And we have had situations come from other advisors whereby, you know, their expectation was that they had perhaps 9 months more of being non-UK resident, when actually the reality is that they were likely already to have triggered it. And suddenly lots of planning opportunity has sort of just gone out the window.
And do you think that's been kind of, I suppose, further complicated by the recent changes in the budget as well?
Yeah, absolutely. I think just picking up on the point that Stuart made about regular reviews, you know, it is best to do them regularly, but there's no doubt that what has recently happened in the budget or last year has really given people a different opportunity depending on what their long-term plans are. I think as well, it's sort of hearing it firsthand, I would say, is always quite important. So we still get a lot of people that have almost got that like secondhand advice, be it residence or income tax or CGT or inheritance tax. You know, friends sort it, and they believe it has the like direct knock-on impact for them. So it's just always important that it's personal to you.
Absolutely. Okay, thanks, Stephanie. Thanks, Claire. We'll move on to IHT planning now. This is probably one of the more complicated areas that we advise our clients upon, particularly from a tax perspective, and to a certain extent, you could possibly argue to become even more complicated with the recent changes in the budget. So I'd like to now kind of pass over to Claire just to kind of talk about long-term residency and take through some of the steps that she would speak about with clients and really kind of guide them through. So Claire, would you mind just going through in a bit more detail kind of IHT planning and how you approach that with clients?
Yeah, sure. So I guess probably one of the big changes that we've seen recently, that you've alluded to is the concept of a long-term resident, and particularly important when it comes to inheritance tax and what someone's exposure is to inheritance tax. So pre-5th of April 25, we were dealing with a concept called domicile. So when we wanted to understand the extent to which somebody's estate was going to fall within UK tax, be it largely non-UK, we always worried about the concept of domicile. But the reality was it's a really difficult concept to advise on. You know, there wasn't sort of a globally recognised law. The UK very much focused on case law. And there was a lot of cases where HMRC really challenged an individual's domicile on death. Because if somebody died with a UK domicile, it was their worldwide estate, you know, perhaps gifts that they made in their lifetime that were going to be assessed. So there was a lot of money in it for HMRC trying to establish somebody with a UK domicile potentially. From the 6th of April 25, we have essentially eradicated the concept of domicile for UK tax. So income tax, CGT, but also inheritance tax. And we've moved to this long-term residence test. Now, a long-term resident is an individual that when we look back over the last 20 years, so it is something that we have to keep retesting. If they had been UK resident, and that's going to be under the statutory residency test for 10 of those years, then they are a long-term resident. And that position is very like a domicile, UK domicile. So worldwide estate, potential, you know, in charge. For someone that's not a long-term resident, be at the time of gifts or perhaps at their death, it is UK cited assets only. So the big, I suppose, most interesting change is that where we've spoken to individuals that have lived outside the UK, you know, in the UAE for 10, 15 years, were UK domiciled, they still have those quite significant ties to the UK, meaning that would have remained for them. Suddenly, this change of legislation means that actually their IHT, you know, the scope of their inheritance tax liability in the UK has really reduced quite literally overnight on the 6th of April 25. So in terms of reviewing and looking forward, this gives people massive opportunity, not just again to understand what it looks like now, but also really perhaps to scope future plans, and just the benefit that perhaps this is given or could give somebody. So where we start looking at inheritance tax planning, and this would be for a long-term resident or for someone that wasn't, a long-term resident, it doesn't really matter. The first thing that we always start with is to establish the size of the problem. Now, what I mean by that, is if the worst were to happen today, how much would we be looking, or would your executors be looking at handing over to HMRC? When we understand that, it's only really truly when we understand that, and also where Stuart's team come in heavily with regard to, cash flow forecasting, can we then start to think about whether we have a group or a pool of assets that actually that individual could give away a little bit sooner. So then we start to think about succession. And what I mean by succession is making sure that assets are passing to people that you really truly want them to pass to, but also perhaps the timing of that. Sometimes it might really be really good idea on paper to give, lots of value or even your estate all the way. But actually, if the reality is that you're giving them to a 21-year-old child, is that the best thing that you want to do for succession purposes? When we have that conversation, we start to look at, I suppose, what the tax, bill would be in a little bit more detail and familiarise ourselves with allowances. Now, there's a number of allowances within the UK inheritance tax. Typically, the Conservative government used to hit the press quite a lot with this £1 million could be given away between husband and wife. But what's really important to note, certainly with this concept of the new LTR, is that where if any individual sort of discusses a concept with something called second death, and that's typically where we felt that one estate could pass to another individual, particularly a spouse, and it would only be the second death that would trigger this inheritance tax liability. And that was because of spousal exemption that existed for inheritance tax purposes. Where we have an individual that is a non-LTR and an LTR, that spousal exemption doesn't necessarily exist between them. So it's really important that not only do you understand your own LTR position, that you understand that of your spouse as well, because it could have considerable impact on your estate. Next, when we look at mitigating, we want a simple strategy. We don't want anything complex. We don't want anything that no one understands. We try and look at simple things to reduce the value of the estate. We then advise to take action, and then we can almost revisit where we got back to and assess again what the size is of the problem. And a bit like Stuart said earlier, this can be under review. It's not uncommon that we might review an inheritance tax liability or estate and come back 3-4 years later to see whether we want to revisit it, whether there's any more opportunity to mitigate more taxes.
Some really good points there. I think, Stuart, one of the kind of interesting things I was picking up as Kay was going through that, and you mentioned about it before, but cash flow modelling is something that we use with a lot of our clients. Would you mind just kind of touching upon how we use that when it comes to IHT planning in terms of, I suppose, helping quantify how big a problem might be and how a problem might evolve from now looking forward?
Yeah, sure. Because, when you're calculating your earnings tax liabilities, it will come down to the value of your assets. And obviously cash flow forecasting will demonstrate what the current values are. It can also demonstrate where you've maybe had a capital expenditure that may have reduced your estate. It may also result in looking at how you've restructured the wealth over time as well, where you might have done things that start to take things out of the estate, and those sometimes will reduce over time. So it's about understanding the current picture as far as what's currently trapped by inheritance tax, and the cash flow forecasting is a great way of just getting a sense of, what does my current liability look like, because it will change with values changing, what you're currently holding changes, maybe expenditure that you've made as well during that time. So it's just making sure that you understand at any given point what the current state of play is, and cash flow forecasting gives you the most accurate picture when you do your reviews.
Absolutely. So next we wanted to move on to, thank you for that, Stuart. Next we wanted to just move on to some of the kind of main pension considerations. Obviously for doctors moving to the UAE, if you've been in the UK, you may have built up entitlement to a defined benefit scheme. Moving to the UAE, things work differently from a pensions and retirement point of view. Pensions aren't on a product that you can have or establish in the UAE. They have slightly different options with that regard. So would you mind just kind of kicking off in terms of talking about some of the main considerations, and then Claire, it'd just be interesting for you to also kind of comment with regards to some of the taxation rules that you need to be aware of as an expat as well.
Yeah, of course. And I'll absolutely ask the tax part of it over to Claire. She knows a lot more about it than I do. Yeah, so when it comes to pension planning, it's really important that just because you don't get access to a pension as we know it over here, you can still very much plan for retirement. And you can also plan with your actual existing pensions as well. Now, one of the things that we would always look to do is to sit down and look at any pensions that you've got, whether it be an NHS pension that might be now deferred, or you may have some personal pensions that you've had over the years from different jobs. We'll sit down and look at the current situation that you have and how the money's currently sitting. We'll also look at other investments that you've got, and then we can look at saying, okay, what would be optimal from now? Quite often what we will do, we see a lot of people who've taken things on a kind of transactional basis over the years, and we can look at putting all the pensions together into a single pension, for example, that might be more efficient, less cost involved, might be more tailored to your risk appetite as it is today, because quite often when you bought things in the past, it was at a different time in your life, your risk appetite might be different. Pensions may have changed since you first took those out, and investment opportunities may have changed as well. So it's about looking at, can we consolidate things and make it more efficient? And our job is to make sure that we can demonstrate a value and an advantage of making any changes. But one of the things that we also always do is look at putting people into a situation where they can save regularly, even though it's not into a pension, you can save tax-free over here. So it's looking at, again, building a very flexible, very cost-effective way of saving for your retirement, giving the opportunity to put lump sums in occasionally if you wanted to ad hoc, and whatever you can consider we could do. So if you want to build the vary your payments, you can vary your payments, stop your payments, restart them, put lump sums in, take money out, whatever you want to do, we can do it. And it doesn't come at cost to have that flexibility. Also, we can look at the in-the-service gratuity that you may be provided through your employer, and we'll also factor in what does that look like, and we can usually work out and calculate what the value of that would be as well over the years, depending on how long you stayed. And it's about having that full picture at any given point based on, the savings that you've got, the pensions that you've got, how they're working, and the service gratuity you'll have as well. And again, to get back to the cash flow forecasting, put that into the machine, run the numbers forward, and just make sure I've got a clear picture at any given point as far as where you are with your pension savings. Now, for the other parts from tax, I'll now defer to my learned colleague, Leah.
Thanks, Stuart. I don't want to start with income tax, actually. I just want to start with inheritance tax, because it's probably, I guess, been on people's minds the most. So, again, from the last budget, we heard that from April 2027, the government are looking at putting UK-cited pensions within the scope of inheritance tax. They've never been before. I would add, whilst it is certainly an indication of direction of travel, it is purely at the moment as a consultation. So we don't know for fact that it is going to happen. But I certainly think it's worth considering within your plans, certainly if your pensions are sizable within the UK. So in terms of income tax, and I guess fitting in a little bit to what we might do, if we do find, for example, that pensions fall in, we've always looked at leaving pensions until last. So pensions being, very IT efficient, why draw down on them if we needed to? It was a way of passing wealth onto a sort of family completely tax-free. That might not be the case any longer. So what we're talking about with clients is, potentially taking out that tax-free element. If you're going to benefit from being a non-LTR, so looking at UK-cited assets only for inheritance tax, do we want more money sitting in the UK when we could quite easily shift it outside? And the same might be as well if we can look at sort of income drawdowns as well on a pension. Now, I would say that as a UK cited pension, it strictly continues to fall within the scope of UK income tax as well. However, we might find that depending on what type of pension it is, the UK and UAE double taxation treaty removes it from charge in the UK. So whilst we've got UK cited asset paying UK income, and we should declare it, actually sometimes those treaties provide an overruling position, and the UAE one does on pensions. Last really important point, though, on that is that there are very specific clauses within treaties for government service where sort of NH pensions will likely fall under. So it's not a given that if we're talking about a pension that you've accrued within your employment within the NHS, the treaty is going to cover it. That might still award taxation rights back to the UK, but we can help you. There's a big list of what's considered government service, what's not, depending on who the payer would ultimately be. And we can advise you the best thing from an income tax perspective to do if you're non-resident.
Thanks, Claire. I suppose it kind of highlights the point that it's vitally important if you have any pensions in the UK, whether they're defined benefit and NHS pensions, whether they're personal pensions, whether there's anything that you've accrued, to review those, to understand the tax implications of holding them, and then based on the decisions that you're likely to make, whether that's returning back to the UK today, tomorrow, 5 years down the line, what options you have available to yourself and what is going to be the most tax beneficial thing and action for you to take. And as Claire said, we try and guide and help and interact on that, and we can never predict the future. Sometimes people plan to move in a year and we find out that they stay for another few years. But I think the most vital thing is knowing what options are available to yourself when you do eventually look to make that move back home, if that's what you are going to decide to do. So thank you, Claire and Stuart, for your insights on that. What we thought we'd do is just to move on to a brief case study before we move on to an example comparing investing in property, which I know has always historically had a lot of interest and traction here. In terms of the case study, we've got Dr. Williams and Dr. Williams, age 50 and 48. They moved to Abu Dhabi in 2009, so they've been in the region for a while. They do have one child, age 22, working in the UK. They're both full-time doctors. They have property both in Abu Dhabi and the UK. Mr. and Mrs. both have a UK pension. They have an investment portfolio, some cash, and also some NHS defined benefit pension. Now, in terms of priorities, one of the first things that we do with our clients when we sit down with them, we talked about cash flow forecasting and modelling that we do with our clients quite a lot. Before we get to that stage, though, and probably the most important part is just understanding what people's priorities are and what their objectives are and what they're trying to achieve. So we've tried to summarize a few kind of key points here, and I'll ask kind of Claire and Stuart some questions around these. So just by way of example, on the second point here, Claire, foreign income and gain rules and IHT. If we're looking at this particular client, are there any particular points that would spring to mind that you would raise with the client with regards to foreign income and gain rules and IHT, just looking at the circumstances, the assets they've got, and then potentially the income that they have now, but also in the future?
Yeah, so I suppose if this sort of came across my desk, one of my first questions would be what are their plans for the UK? Are they considering going back anytime soon? So they've been outside of the UK for more than 10 years. We'll assume successfully all of those years were non-UK resident. So starting with inheritance tax, they've got that new sort of non-LTR position. They're going to want to restrict their UK assets as much as they possibly can. Now, there's no trailing provisions currently in legislation for inheritance tax. So if they had UK property that perhaps they weren't using, perhaps they were using as an investment, that's quite a sizable inheritance tax liability on that value. So they might want to consider selling. They need to consider CGT, but they might want to consider selling and sort of shifting that value outside. And exactly the same for the UK investment portfolio. So if they're UK cited stocks and shares, they won't be stuffing CGT on that. The income still might be within charge to some extent, but certainly the value would fall within the estate. So even if their plans are to go back in 3, 4, 5 years, I would still certainly suggest they shift them out now because they're going to be non-LTRs for some time. With the foreign income and gains rules, Sorry, Dale,
I was just going to say, really good point, but carry on.
With the foreign income gains rules, again, something else that came in the budget. So typically when people going back to the UK, certainly if they were UK dom, the expectation was that from day one, they were going to be within the scope of UK tax for income tax and CGT. What the foreign income gains rules do now for an individual that has been non-UK resident consecutively for 10 years is it allows them to exclude, and a claim is needed, and there are some complications around that claim, basically exclude from charge non-UK income and gains for 4 years, 4 tax years post-arrival. So one of the other things that I would be saying to these clients if they're going back is certainly let's ship those monies outside of the UK, because inheritance tax benefit, but also possible income tax and CGT benefit going forward. But let's make sure as well that they're in a structure that we can easily report on when we're in the UK, because that's going to be quite important.
That's fair. And Stuart, how does that link into, and I suppose to the next point really, investment review, looking at investment structures? I mean, we say investment review here, that's quite a wide statement, but just linking that to what Claire's just said, how would that impact how we'd look at things from an advice point of view in terms of what investment structures and approach we'd look to undertake?
Yes, I mean, we'd have to really fully understand what the future views are on various things, but certainly with them being outside the UK for a while, you'd want to be looking at making sure things like their investment portfolios had non-UK cited assets and things like that as a consideration you definitely want to consider, because that's just quite important that the ISIN number of the funds that you're using aren't going to be considered a UK asset. So that's certainly something you look at. Also, when you're looking at considering investment into a property, I know we're going to come on and talk about that, but I think it's really, really important that you understand the driver for that. I mean, a lot of British people are it's kind of endemic into us that we're kind of drummed at us from a young age that if you ever get any extra money, buy property. It's all the bricks and mortar. And that's helped a lot of people in good stead over the years. But successive governments and changes in tax rules have made it so that there's a lot less attractive than it used to be, and people need to understand the impact of that. And I think we're going to come on and talk about that in a bit. There's another thing I always say to people: if you really want to buy a property for a reason that's important to you, or you're intending to live in it, or it's got any sort of emotional tie to it, then fair enough. If you're buying it just to rent it out, then just be aware of the costs that come with that, as opposed to investing as an alternative.
Yeah, great point. Thanks, Stuart. And one final thing. I mean, we've mentioned it under here, and we've talked about looking at their overall tax position. We've covered IHT. With regards to wills and estates, this is something that comes up quite often. Obviously, a lot of people might have a UK will, for example. They spent several years in the region. Would you mind just kind of touching upon the position with regards to the kind of estates, wills in the region as well? Because again, I think sometimes there's quite a bit of misunderstanding about, okay, I've got a UK will, it's up to date, it covers everything. I don't really need to worry or think about that whilst I'm living in the UAE.
Yeah, sure. I mean, very quickly, the position and the Sun's default position we always take is that you probably need to have a will set up in each jurisdiction where you actually hold assets. I mean, it's the UAE as well, and you've got your children, you want to have a will in place in case that you fall foul of guardianship laws under Sharia law as well. So it's about making sure that you've got what standard one being non-reasonable, something that's called a DIFC will, which would effectively manage your affairs for the assets that you have in UAE, but also it can be very, very good in helping manage your affairs should somebody die, and you're very, very, very clear that how the kids have to be looked after, who the guardians have to be, and everything else. It's important in this part of the world that is in place. It doesn't cost that much, but it can save a lot of hassle.
Brilliant. Thanks, Stuart. So we'll move on to, when we were speaking to Dr. Nadia about this, I think this is quite an important kind of comparison to show, because as Stuart was saying a few moments ago, I think there's this natural assumption because we're British, the default position is right. Property is it's a safe haven. It's something that we can touch, see, feel, It's almost a default position for the people to invest in, and particularly for expats. But what we thought would be useful is just to show a head-to-head comparison. So in this particular case, we've got Dr. Shah is age 49. Our risk profile, and what we mean by risk profile is for every single client that we have, we do some psychometric testing just to have a look at what their general attitude is towards investment risks, what their tolerance of loss might be, just to get an understanding as they might want to take with their investment portfolio, anything from very low right to very high. In this particular example, we've put medium or moderate risk. She's receiving rental income from a buy-to-let of 24,000 per annum gross. And the goal was to invest £500,000 in a property for 10 years plus to build wealth and possibly prepare for a return to the UK in 10 to 15 years' time. In terms of her tax status, she's UK non-resident for now. Obviously, she's been living abroad, but is concerned about a UK return in future and her exposure to UK taxes. So what we'll do is we'll just firstly go through the numbers, and then Stuart and Claire, I'll get you to comment on some of the main points and the reasons that the numbers end up as they are. So in this particular example, comparing a UK property buy-to-let portfolio against GIA just means general investment account. So the investment account invested in a global diversified portfolio, so not just linked to one geography. We tend to diversify a lot of our portfolios across different asset classes, but also across different geographies. And in this particular example, the initial costs of acquiring the UK property, the buy-to-let of 44,250. For the general investment account, global portfolio is £5,000. The ongoing costs are slightly less for the UK properties, £5,000 per annum. For the general investment account, the portfolio, it's £9,000 per annum, so higher. The tax for the particular property is £2,280 per annum. For the GIA portfolio, there is no tax that applies. In terms of capital gains tax, if the property was sold for a significant profit, in this particular circumstance, the capital gains tax was £70,000. For the GIA portfolio, if it is set up in the right manner and the right way, and gains are realised at the right time, the gain is £0 in this particular example. And inheritance tax, again, dependent on and taken into account, the circumstances could potentially be up to £200,000 if the value of the property or the investment portfolio was above the IHT threshold, taking into account the rest of the estate. So when you work out those figures and follow those through, the total cost after 10 years, excluding any inheritance tax, for holding a UK property, 187,000, holding and selling, should I say, sorry, £187,050, and for the general investment account, 95,000. So if you're looking purely at cost, particularly taking into account tax, actually, we're not saying that UK property isn't something that you should hold, but actually, when you compare the two and look at a direct comparison, it's actually not completely obvious that you should invest into property. In fact, in many circumstances, an investment account might be most suitable. Now, the reasons for those particular costs, if you look at the UK property, I think it's easy to forget some of the costs are attached with purchasing property, stamp duty, legal costs, getting a valuation, getting a survey. With an investment account, obviously, there are certain costs attached, initial financial advice fees, there might be a small platform fee. But as Stuart was saying before, most of the investment portfolios that we look at don't have an entry fee for just going into the investment portfolio. If you're looking at ongoing costs for the UK property, it's things like safety certificates, letting agents fees, insurance maintenance, decorating. When you compare that with the investment account, there's ongoing advice fees, platform fees, and investment fund fees. So those are the three things that you have to worry about broadly on an ongoing basis, and depend on where you're investing. That can be anything from 1.5 to 2% per annum. And then you look at some of the other areas, liquidity. Obviously, UK property isn't very liquid. If you want to sell it, it takes a certain amount of time to sell, can take months. With a general investment account, as Stuart said before, you do have a lot of flexibility in terms of liquidizing your assets. You can usually do that within a few days. In terms of diversification, for the UK property, pretty low. You're investing in a single asset class, which is property. It's in the UK, obviously it's exposed to the UK geography. With regard to the general investment account portfolio, as we said, you can invest across different geographies and also in different asset classes. And the whole point of that is at any one point in time, there might be one country stock market that's doing better than another. But also as well, when you look at asset classes, there might be times when equities are performing better. There might be times when fixed interest is performing better. There might even be some times where deposits are holding up better than any other asset class, as we've seen at certain points in history. Then when we look at tax, Claire, I'll probably introduce you at this rate, but with regards to kind of holding UK property in the UK, is it fair to say that people sometimes forget about the tax implications of the rental income that they're receiving, and should it be a concern for them?
Yeah, I think people do to some extent forget, or perhaps they focus quite a lot on the cash flow position. Certainly when people are paying out things like agents' fees, maintenance, etc., and a mortgage, it doesn't necessarily feel like they're getting a lot of cash or benefit every month. But the way that in which we calculate a profit for UK tax does take into account a lot of the expenses, but it doesn't take into account mortgage any longer. So a number of years ago, it used to take into account mortgage interest when we were directly calculating the profit. The way that it's worked now is that we almost calculate the profit before we consider mortgage interest. And then mortgage interest is given as something called a tax reducer at 20%. And what it did, and there's no doubt the government knew that this is going to be the impact, it took a lot of people that weren't necessarily paying tax and rental income, and it moved them into a position where they were, despite them not feeling perhaps cash rich from that transaction. And there's also the administration side as well on it, of having a property, not just from being the landlord perspective, but also in terms of taxes, perhaps having to report these to HMRC, annually, things like non-resident landlord schemes.
Thank you. And Stuart, if you compare that to a general investment account, which many of our clients are invested in from a tax point of view, and again, if you've been non-resident for a number of years, would you mind just sort of touching upon why it's particularly beneficial and why general investment accounts tend to make quite a significant part of our clients' portfolios?
I mean, the general investment account is there because it's cost effective, it's low cost, it's easy to set up, it's very flexible, and you can dictate, what you hold within that. You've got the whole market of funds available. Make sure you pick the right asset class for the people that diversify portfolio. You can change it relatively easy. You can rebalance it automatically if it's through a discretionary portfolio as well, which saves a lot of hassle. But the big thing I like to say before we moved on to the questions was that, we mentioned on the previous slide about the fact that inheritance tax could be up to £200,000 with both options. The key thing is, if you've got money in a GIA, we can use wills and trust structures in order to actually take that out of inheritance tax and save you an awful lot of money on the money you'd ultimately move on to the next generation. Whereas in property, it's now impossible to do anything from an inheritance tax with a property, especially if you don't want to fully give up any rights to the property whatsoever. So, again, it's a huge thing. And inheritance tax of 40% is a big consideration. And I always get a little bit of a fright when I meet somebody who's sitting on 30 properties and is married to all of them. Because there's absolutely nothing we can do about that. The family's going to get enormous inheritance tax bill.
Yeah. And still, I'm sure, we've both seen this before with clients, where you have clients who have held buy-to-let properties and rental properties quite a number of a course of years. They get to a certain age where they want the administrative burden. They're worried about IHT, and they turn around to you and say, right, can you solve this problem for me? It's not an easy problem to solve because they've got such significant capital gains on the property.
Yeah.
So if they sell them, there's a huge capital gains tax bill. As long as they keep them, they're inside of yeah. So there's no easy solution once you get to kind of that stage. We've seen this many a time, partly fall in the past.
Plus, you need to make sure you don't fall into that category of becoming asset rich and cash poor. And I've seen that a number of times.
Yeah, absolutely. Okay, so what we'll do, Claire, if I could ask you just to cover some of the, because again, I know this will be on a lot of the doctors' minds, some of the kind of main tax considerations from a UK property point of view. I know we've covered a couple of these already, but maybe covering some of the points that we haven't managed to get through, and then we'll move on to a Q&A.
Yeah, I'm gonna skip a lot of the bullet points because I think we probably have touched on them largely. I think the first one is worth saying that when people have got property in the UK, we always need to consider it from a tax residency perspective. Not if it's being let out, but if it's available to you. It might ultimately end up limiting the number of days that you can come into the UK. It's not going to make it you resident on its own, but it might be a restricting factor for you. So that's worth bearing it in mind. CGT, even as a non-UK resident, there is a slightly sort of more advantageous way, or two ways potentially of calculating that gain. If you sell as a non-UK resident, any taxes to be reported and sold to HMRC within 60 days. It's not very generous limit. And the last thing to say is on principal private residence relief. So lots of people with UK properties that they lived in prior to moving outside of the UK. And the way the principal private residence relief works, so that relief really as to why anyone buying and selling, their prior residence in the UK doesn't pay tax, it sort of reduces over time. The benefit of it reduces over time. So it's always worth, if you've got UK property, much you're not really using it anymore, it's available for your use, perhaps you've found yourself, you're not an LTR any longer, that's quite a significant asset in the UK for HT purposes, it is worth sort of looking at what that CGT liability might be, the benefit of perhaps principal private residence relief you're getting currently. And we can always illustrate, what would that look like in 2 years, 5 years, and etc. Really just to demonstrate that the sooner the better, really, generally for the sale.
Brilliant. Okay, thanks for that, Claire. Just conscious of time, so probably hope it now to just move on to the Q&A, because I know there's a few questions which have popped up in the Q&A box, and we're trying to get through as many of these as we can. So the first question I have is, what are some of the unique challenges British doctors face in the UAE when it comes to retirement planning, and how can we overcome them, particularly with respect to ensuring that we have enough for when we stop working? I think, Stuart, this is definitely one for you.
Yeah, so I get those parts of what I was saying before. Is just making sure that first and foremost we start off by knowing what the full picture is, and we understand what benefits are available through maybe NHS pension, technically you have other pensions that you've got, making sure that they're consolidated, making sure that they've put into an actively planned strategy for retirement, which is always going to be revisited so you know what the numbers look like. There are always ways to save on a regular basis, and there are always ways to invest on an ad hoc basis. And it's about taking advantage of that tax-free earnings where you can, and then just preparing yourself so should you go back to the UK, you've also built up funds you could then use to make potentially pension contributions back in the UK if you're not retired, Jeff, which are also a tax relief, and just giving yourself the opportunity to kind of turbocharge retirement. And that's kind of the way I've seen it, and other people have seen it. You've been expats for a long time.
Absolutely. There's a couple of tax ones here, so I think we'll move towards Claire for these. Read Dr. Shah, is her buy-to-let portfolio in her personal name? So in that particular case study it was, but the kind of pertinent part of this question is, what are the advantages? And again, Claire, I'm sure you've been asked this many a time. What are the advantages of holding a buy-to-let portfolio, but using a limited company to hold those assets?
So if someone's starting off and they haven't invested yet, there can be benefits, because the biggest trouble that we see, if those properties are already in their own name, is getting them in tax effectively. I think the advantages can be, in some case, slightly lower tax rates, certainly for people that are UK resident, corporation tax is lower. But if ultimately we need, or someone's going to want to draw on the income, then actually the way that corporation tax initially taxes the profits, and then you have to look at dividend taxation, it ends up being worse. the real key benefit, I think, at the moment, there's been sort of chat about whether they'll remove this, is the way that mortgage relief is relieved. So I mentioned how it's relieved for an individual, it's taken that tax reducer. With income companies, it's still calculating the profit. I think probably one of the main reasons that people tend to steer clear of property portfolios, perhaps that might need to be mortgaged, is still because of the difficulty in obtaining mortgages within corporate. That's probably, I'd say, the biggest hurdle, and then the additional administration costs. So typically we see individuals that might have 10 properties plus, they're within a company, and there might be benefits as well. They can do things like family investment companies as well with them and start sort of benefiting the next generation. But if it's one or two, or perhaps, one is a home as well, and you want to benefit later down the line for that principal private residence relief, and it's better to keep them outside.
Yeah. So I suppose it's fair to say, in a way, if you've only got one or two properties, for the level of complexity that cost and the tax benefit, in a number of circumstances, holding them within a company might not be the most beneficial thing. If you've got a more sizable portfolio, then there might be considerations where it becomes attractive to do that. So Dr. Francis says, is submitting a P85 form needed if you are going to continue self-assessment tax returns for renting UK property?
So no, a P85 is typically the form that someone might want to submit if they've left the UK. It's not a statutory form, and that means that legally you don't have to. And we tend to see that though there's a benefit if someone's continuing with a UK employment or perhaps UK pension, and then you want something called a non-tax code in place. So that form is the mechanism to sort of declare to HMRC your intention as to regards to being non-UK resident. It helps getting those tax codes in place. In respect of rental property and declaring the tax, there's actually a rule in the UK that if a property is rented by a non-resident, either the tenant or the letting agent need to deduct 20% tax at source. The way out of that is the non-resident landlord scheme, which basically allows you just to declare everything through self-assessment. So there's slightly different things. You might find people doing both.
Brilliant. Lots of tax questions coming through here. So next one was, if I'm permanently residing in the UAE, but doing locum work in the UK, which I'd imagine could be a fairly common scenario for the doctors. So if we're permanently residing in the UAE, doing locum work in the UK, and which I am paying UK tax, UK income tax, will that take me into non-resident status?
So despite being so incredibly closely linked, they're technically two, I suppose, different things. So the first thing that we always consider in these scenarios is what is the impact to residency. So when we're looking at residency, there's two places that sort of work exist within this large statutory residency test. The first is if somebody's wanting to be non-UK resident purely because of their overseas work, there's extensive hours, things like that, and they might be following something called the 90-day tie. Within those 90 days, they can actually work no more than 29 days in the UK in a tax year. And those would certainly be UK work days. So if let's say we get past that, or perhaps we don't, we try and get something down to the sufficient ties test, then actually working for 40 days in the UK then becomes a tie, and in turn can reduce your UK day count. So work in the UK is certainly something you have to be aware of from a residency perspective, because it can have an impact. It can make people UK resident. Let's assume that it hasn't. We've got people working in the UK as non-UK residents. It is going to be UK taxable income. So if tax is being deducted at source, that's the right thing to do. It might be that the code is wrong. Might be that you've got a full personal allowance, and actually more tax is being deducted at source than needs be. But a simple tax count could be able to identify that.
Right. Thank you. Moving on to you, Stuart. Interesting question here. So what are your thoughts on converting some of your combined estate, if returning to the UK, into non-CGT assets on easily gifted things such as gold, sovereigns, classic cars, this one possibly close to your heart from your part of the world, whiskey casks, etc. And are these gifts HC exempt?
Obviously, just buying whiskey, or drinking, obviously only. You don't have to get that exotic to manage your tax affairs. It's never a go-to for us to say, we've got a great idea on buying gold sovereign coins or buying a classic car, but with those things comes their own challenges like storage, upkeep, maintenance, to maintain values and things like that. So there are lots of ways through financial planning and through using proper structures that we can protect money from capital gains tax and inheritance tax before we have to get that exotic. And that'd be my quick answer on that one.
Very diplomatically answered.
Other than buying whiskey, of course.
So just moving on to the next question. Hopefully we're still good for time. Thank you so much for a great talk. Could I ask what you would recommend would be the best way to shift value out of the UK when selling a property and paying the required CGTs? So I guess this particular individual has a UK property. Is maybe thinking of shifting that away. Would it be the general investment account? Also, if you have shared property with a parent and both are non-long-term resident and you ideally want to keep the property, is it best that they gift their half to you early on? It's quite a layered question. So I suppose for the first part, Stuart, what would you recommend would be the best way to shift value out of the UK, selling a property and paying the required CGT? Would it be the GIA, in your opinion?
No, I mean, this comes down to individual circumstances, and it comes down to, what your planned life plan looks like the next sort of 5 to 10 years. And this is where you have to really engage with a professional firm to understand, based on your particular circumstances, what is the right solution. So I'm afraid there's not a one-size-fits-all. The GIA is very flexible, but there are scenarios where we wouldn't recommend it because of other circumstances that the customer has.
Yeah. And Claire, just to answer the second question, which is a really interesting one, again, you see quite often where you've got kind of dual ownership of a property, parents maybe owning half and or owning a property and looking to gift because they might benefit from an inheritance tax point of view. But yeah, if you have a shared property with a parent and you're both long-term resident and you ideally want to keep the property, is it best that they give half to you as early as possible, in your opinion?
Yeah, very probably. Again, it depends a little bit on the circumstances. So UK property is always going to be within scope. So we would be relying on that sort of 7-year rule, that potential exempt transfer rule. I'd want to understand if they were going to continue to use it, because we've got legislation that doesn't matter if it's given away, actually continue to use some benefit. There are some sort of de minimis in there. HMRC want to sort of pull it back into their estate. There's always CGT to consider. And actually sometimes towards later life, this becomes our biggest consideration, is timing. Because whilst for inheritance tax purposes, we always want to gift as early as we can, and trigger a gift, because there can be benefit even if someone passes away within 7 years. If someone was in a really unfortunate position where they gifted an asset, had to pay some CGT, because they're in a gain, and then passed away, say, a week later, and then suffered IHT, there's no credit for CGT against IHT. So potentially, but we'd want to understand a bit more, and we'd possibly as well want to talk about some insurances.
Thank you for that, Claire. And we'll take one final question and then we'll to wrap things up, because I'm conscious of everyone's time. As I last said, if you do locum work as non-resident, but later in the year you have to be back permanently, when would you become UK resident? Would investments need to be changed before you do the locum work for 30 days and return to the UAE? So, Claire, if I could ask you to try and unpick the first part of that question.
Yeah, no problem. So it's really dependent on personal circumstances. So when we look at residents, we assess an entire tax year. So if someone's become resident in the year, the first most important thing is that they're resident essentially from the 6th of April in that year. Only then certain circumstances, there's only 5 possible cases on the way back into the UK, can we actually split that tax into a period of non-residents and residents. So sometimes not always possible. So the fact that they're working in the UK prior might, ultimately impact their ability to get to that year. It can be based on a lot of things, though. It's really difficult to know without looking at it.
Yeah, it's so interesting when you. I love the questions, and thank you for sending the questions through, everyone. And a few of the answers which Claire and Stuart covered brilliantly, but also you'll see the kind of common thread, which is it depends on people's circumstances, and it's absolutely not a get out clause. It's just to say, as Stuart was really safe and pointing Claire said many times, it depends on the individual circumstances as to what the best advice is. And so the most important part for us is really kind of knowing and understanding people before we advise them, because there isn't a one size fits all for everyone, particularly when it comes to tax and financial planning. So we've managed to get through virtually all the questions. As I said, I'm kind of conscious of time. Dr. Nazia, was there anything in particular that you wanted to ask or wanted us to cover, or we haven't managed to cover today? We appreciate there might be questions afterwards, so if people want to share those with you afterwards, they're more than welcome to, but just wondered if there's anything else you wanted us to answer whilst we're on the webinar.
There are a few more questions put out there, but I think what I'll do is I'll send them to you, and then if you could get back to us, I can give it to them individually just to reduce time. But yeah, I think it was a great session, a good overview of stuff. But I think overall what it sheds light on is that everybody's situation is individual, and you'd have to have an individual discussion to see what your own sort of situation is and what's the best way to navigate through that. I know I have 100 burning questions for you now, so
I'm sure doctors can understand need for a proper diagnosis.
Yes,
definitely that will. But I think some of the fears are around inheritance tax and capital gains tax and how to mitigate some of those where possible, not knowing what you're allowed to put forward for allowances for those particular things, if any. I think those are probably some of the things that I'd be interested in personally.
brilliant. Thank you for that. So you'll see the usual compliance disclaimer flash up on screen. So I'm sure you've all been able to manage to read that in 5 seconds. But it goes without saying, first I'd like to thank Dr. Nazia for sending the invites out, getting everyone together. I'd like to thank the doctors for managing to join the session this evening. We appreciate you're very busy people, and finding the time isn't easy, particularly on an evening. Claire, I'd like to thank you for joining us from your seats, and Stuart yourself as well. Thanks for brilliantly handling those questions so professionally. It goes without saying, as I said, if there's any questions that you want to fire over, please share them with Dr. Nazia. We'll get through as many of those as we can following today's session. And also as well, if anyone wants to have a more in-depth conversation with us, we'll make sure we share details with Dr. Nazia as well, and feel free to contact us by that method. But apart from that, thanks everyone for your time today, and we hope you found the session informative.